Hello. In this video, we'll consider the tax consequences of contributions to the partnership with respect to the partner and the actual partnership itself. Now, it's important to understand that, yes, this topic refers to contributions to partnerships, but with that, we also can deal with formation of a partnership. Now, the general rule is under section 721, and this says that non-recognition of gain or loss on contribution of property by the partner to the partnership. Now, this applies to both the partner and partnership. Now, what we're dealing with here is whether it's formation or a partner is actually contributing to a partnership, either one. And we're dealing with property. So this is property being transferred in exchange for a partnership interest. So this is an interest. And again, interest is exchanged. Now, this does not cover services. That's important to understand. Services are not covered in this rule. Now, I want to make note that you might recall, if you watched the video on formation and contribution with respect to a transferor to a corporation, that to get non-recognition treatment, right, the same non-recognition treatment, you had to receive 80% or more, so greater than or equal to 80%. And it could be a group or a specific transferor, but it had to be 80%. Now, it's important to note that here there's no requirement with respect to how much ownership. So it could be 100% of the partnership, or it could be 0.001%. This is huge. This is a huge distinction. So there is no control requirement. So no control. You do not have to have control of the partnership. You just simply have to be a partner receiving a partnership interest, and it has to be exchange of property for a partnership interest. Now, there's a special rule that applies to investment type companies, just like we have in section 351E. That's noted down here, so you can take a look at that. That's noted right here. And again, we compare the rules under section 351, which, remember, the key distinction is the control requirement. There's no control requirement met. Again, it can be less than 1% ownership or 100% ownership of the partnership. This rule still applies. And again, 721, no gain or loss recognized with respect to property transferred to the partnership and the partners receiving an ownership interest. Now, I say partner, but it could be a member of an LLC. All right. See the previous video on the discussion of when partnership treatment is applied to various entities other than partnerships under local law. So the basis rules. So the basis rules that apply under section 722, this applies to the partner. So it applies to the partner. It's the partner's basis in partnership interest. And we refer to this as the outside basis. So this is terminology you need to keep in mind. Now, if there's any gain recognized, we add to that. So we increase for any gain. I'll mention how gain can be recognized in a moment. We have to consider the shifting of liabilities. I'll mention that later on down the presentation. And then just like with section 351 with corporations, tacking of holding period only applies for capital assets in 1231. So what do we mean? If the partner is transferring property that's considered capital or 1231 asset, that portion, which we look at the fair market value, tax on with respect to that, the assets being contributed, which can be huge because it could already be long-term capital or could already be 1231 in nature. And remember, just like stock, a partnership interest is going to have a general treatment as a capital interest, which we'll see later on in a later video. Section 723 applies to the partnership. The partnership. So 723 is the partnership, while 722 is the partner. It's the adjusted basis rule. And it carries over. It carries over from the contributing partner, and again, gain is recognized. Gain is added on. We increase for any gain recognized by the partner. So now I want to discuss how exactly a partner can have gain with respect to this transaction. So you might recall, with respect to section 351, we had a special boot rule, the lesser of boot rule, right? The lesser of the realized gain or the amount of boot. With respect to partnerships, 721, we saw on the previous slide, section 721 says no gain or loss recognized by either the partner or partnership. So no gain or loss recognized. However, if the partner receives boot, which is anything other than than the partnership interest, that portion must be recognized. Now it's different. It's not the same application of 351. It's a bifurcated transaction. It's bifurcated. Bifurcated transaction. So let's say that, let me go to the next slide because it gives us some room. I'm going to write down here at the bottom. We'll come back to the liabilities, but I just want to do an example. So an example of how you can see boot. And this is under the regulations in section 721. So this is under the regs of 1.721, various regs. Let's say that partner A contributes to the partnership a piece of land with a fair market value of $1,000. And the adjusted basis of that land, let's say, is $900. Well, the partnership interest, let's say that in exchange for this piece of land, A receives a partnership interest, which again, remember, the percentage does not matter. A receives a partnership interest with a fair market value of $900. So that's a partnership interest of $900, and also receives cash of $100. Well, this cash of $100 is considered boot. So the idea here is that it's bifurcated into two parts. What do I mean? Well, the land is exchanged 90%. So you do the total amount. So this is equal to a total of $1,000. So 90% of the transaction, 90% of the land is transferred for the partnership interest, which that portion, there's no boot. But 10% is for boot. So what we do is basically the $100 of realized gain that's here, this is realized gain to partner A, that goes unrecognized generally under the rule under 721, that 10% of that, so 10% of the boot times $100, $10 will have to be recognized. Now contrast this with section 351 boot rules, because remember, it was the lesser of the amount of boot, which would be the cash of $100, or the realized gain of $100. So under section 351, you'd have to recognize $100. But for partnership purposes, under the regs, we only recognize the percentage of the transaction, the 10%, which is $10. Now that $10, going back to our previous slides, gets added on. We increase, right, the $10. We increase plus 10, and then also the partnership adds plus 10. For the outside basis, which is the partner's basis in the partnership interest, and inside basis. By the way, the reason we call it outside basis is because the outside basis, again, is the partner's basis in the partnership interest, which is outside the partnership. The inside basis is the basis of the property inside the partnership. So it makes sense. So keep that wording. All right. So this is the next slide. And again, this example was just dealing with the last two slides. So let's talk about liabilities. So when a partner either contributes property that has liabilities on it, and the partnership will have to assume that liability or take it subject to, then that brings up implications of whether the partner has constructive liabilities, constructive cash, or takes on liabilities. So section 752 deals with an increase of partner shares liabilities, and that is treated as a contribution of money. So what do we mean here? Let's say we have three partners, A, B, and C. Let's say A and B each contribute $100 cash, but C contributes a building with a fair market value of $150, adjusted basis of $100, and a liability of $50, which the net effect, right, of the building is it's $100 net. So each partner contributes something worth $100. So let me separate these in columns right here. Each partner is contributing 100, 100, 100, which we'll say they're each equal partners, so 1/3. So when A contributes property, there's no liability, so A doesn't have to worry about any constructive cash. B, $100, no constructive cash. C, though, has $50 of liability assumption. Right here, the liability of $50. Guess what? That goes to the partnership. So each A and B are increasing their share of liabilities. Why? Because the partnership, and I'll explain what do I mean later on with recourse versus non-recourse liabilities, but in general, when a partner gives property to a partnership and the partnership takes on those liabilities, in general, it's going to be allocated a certain way, but let's say that it's allocated equally for this example. So A and B each have 1/3 of the 50. They actually get to add that onto their basis as if they're contributing money. However, C has a decrease in liabilities because C originally had a liability of $50, but now C only has 1/3 of that. So 50 times 1/3, which is just under $17, $16.67. That's the portion that C is considered contributing to the partnership, but C also gets a relief of the 2/3 of the $50 because C is decreasing the partner's share of liabilities. Why? Because before C owed $50, after C now only owes $16. Big difference. So you subtract the two, and that amount is considered a distribution of money. And we do a net. We net. So what do I mean by net? Well, C is both contributing money and getting a distribution of money. The distribution is the $50. And we'll look more at this later on. Or you should look at some problems on this issue. But we always look at the net effect. So with respect to liabilities, it really does make a difference whether it's recourse or non-recourse. So recourse liabilities deal with liabilities where the person who is with respect to recourse to liability, they are personally liable. So not only is it their investment in the actual item, it's also with respect to their personal assets. The creditors can go after the personal assets of the person who has recourse liability with respect to the loan. Non-recourse liability, though, the creditors cannot go after the personal assets. So it's defined in the regs. Recourse liability, some partner or related person bears the risk of loss. Non-recourse, no partner or related person bears the risk of loss. So that goes along with the definition. So when we have a recourse liability, whichever partner bears the risk of loss, that's who is allocated the contribution of money. It's as if a constructive contribution of money. So partner has risk of loss if obligated to make payment in constructive liquidation and not entitled to reimbursement. So the idea here is that if the partnership liquidated today, let's say the partnership was worth $0, say, I know but this is how it does it under the regs. And each partner has to make good on the liabilities. Well, how much would that partner have to pay the creditor, even from their personal assets? So for this purpose, the constructive liquidation assumes that all assets are sold for $0. Gain or loss is then allocated using the rules, which remember, you might recall from learning about partnerships in a previous video or previous discussion, class, whatnot, that if there's no information, it's equal, but it can be designated. And then liabilities are paid in full. So again, recourse, you're going to allocate based on which partner bears the risk of loss. Non-recourse, though, because no partner specifically has to pay out of their personal assets, with respect to non-recourse liability, you can't do the partner that bears the risk of loss because the creditor doesn't have to or can't go after the personal assets. So the idea here is we have a 3-tier waterfall. And these things, I'm going to give you a general rule that you need to know, but I just want to mention these because if you do go in more advanced topics with respect to liabilities, you do have to consider these issues. So basically it's a 3-tier waterfall. A waterfall in tax means that we go in order. So first we consider the partner's share of minimum gain. Next, partner's share of 704C gain, as if the property were sold for the debt. And then the next is according to profits, or alternatively the reasonably expected share of deductions attributable to non-recourse debt. So I know that doesn't really make sense if you haven't considered advanced topics, but I just want to mention that because that's what the regs do. So what I want to do now is I want to summarize the rules for recourse versus non-recourse liabilities. So if you have a recourse liability, that a partnership takes on, and there is no specific partner that's saying, okay, well, I'll guarantee it. We generally allocate recourse liabilities based on the loss ratio in the partnership agreement. The loss ratio. Why is that? Because again, the creditor can go after the personal assets of each respective partner. So we go after the loss ratio. For a non-recourse liability where no partner is on the line with respect to his or her personal assets, we actually use the profits ratio generally. The profits ratio. Why is this? Let me give you an example. Let's say you're in a partnership. You and two of your friends, and you each are 1/3 partners. We'll call you A, B, and C. You're A, and your two friends B and C. And let's say you each contribute $100 cash. So the partnership has $300. That's it. Assets of $300 and owner's equity of $300. That's it. There's no liabilities. After the partnership is formed, again, the assets are $300. The partnership is looking to buy a building for $2,000. So the partnership borrows $1,700, let's say. $1,700. All right? And they use the $1,700 and they do it on a non-recourse basis, which usually when a liability is non-recourse, there's usually some type of property attached. So the partnership secures non-recourse liability of $1,700 and attaches, or secures, I should say, not attached, but it's the same idea, secures the liability with the actual asset it's going to purchase the building. So the partnership gets $1,700, uses the $300 in addition, cash that they have, and purchases the building for $2,000. Now let's say in year one, the partnership buys the building, it's worth $2,000. Let's say the market goes down. In year three, the building is now worth $1,500. And let's say the liability is $1,600. So you paid off a part of the liability. It started at $1,700 and now it's $1,600 liability. Well, as a partnership, let's say you're not doing well. And you decide, you know what, we're going to liquidate. You're just going to dissolve the partnership because it's just not going well. The economy isn't good. The value of your building went down to $1,500. It went from $2,000 to $1,500. Economy's not good. So instead of paying off the liability, which remember, you paid down to $1,600, you say, you know what? It's a non-recourse liability. The creditors can't go after us. So let's just say we're not going to pay it and they can just take the liability, which, just so you know, that's going to affect your credit. But from an economic standpoint, hey, it's a non-recourse liability. The creditor is bearing the risk. So you're transferring back to the creditor, basically. They basically take the property, which is worth $1,500. They sell it. They get $1,500, and they're paying off the liability of $1,600 with the $1,500. But what's the problem? The creditor lost $100. So for non-recourse liabilities, we always allocate the amount of the partners. I'm sorry, we don't always, but the general rule, I should say, the general rule is we allocate based on profits. Because the idea is that if the partnership is doing well, you are going to pay off the non-recourse liability. But if the partnership is doing not so well, like in my example, and the value of the asset that the liability that's secured for the liability goes below the actual liability, you're just going to default on the liability, and the lender is going to take the asset. So again, profits is what we use because that's when economically when the actual liability will get paid off. But if there's a loss situation, right, or the partnership's not doing well, it's not going to get paid off. It will just default. So this basically just says, what about cash basis payables? And I don't want to go into the details. There's a revenue ruling that deals with this. But generally speaking, cash basis payables, accounts payable, are not considered a liability with respect to this general allocation. The revenue ruling details that, 88-77. All right, so the last topic of this discussion is going back to Section 721, the general rule of non-recognition of gain or loss when a partner contributes property, right? That has an inherent gain or loss in there, right? Remember, it's gain or loss. It had to be property. But what if you have services? If you have services, that rule does not apply. That general rule of non-recognition. Now, if you do have services, if you are a partner that's contributing services in exchange for an interest, you have to distinguish between a capital and profits interest. So first, before I give you the rules, the distinction, I want to distinguish what they are economically. A profits interest just means that you do not have any capital when you receive the interest, or ever. So if there's a hypothetical immediate liquidation, a profits interest holder gets nothing because there's no liquidation value. Versus a capital interest is the opposite of that. You actually have a capital balance. You have to contribute capital. So profits interest means that, okay, when the partnership gets profits later on in the future, you're going to share in those profits. A capital interest means that you do have a capital value, so you have to share profits and losses, and upon liquidation, you actually do get your capital value back. So those of you that are accounting students out there, you might remember that for partnership accounting, when we allocate liquidation, the last step is always based on capital. Now, historically, there's been some changes in the law with respect to this. There was a Diamond case, a case called Diamond and Campbell, which talked about you had to distinguish between the two. And the RevProc did the same thing. And both RevProcs, they did the same thing. Now, RevProc 2001-43 also said that a Section 83B election. Now, RevProc 2001-43 basically came in and said that you don't have to do a Section 83B election. I don't want to get into that. That's a little bit beyond the scope of this, but I just want to mention that. So the current rule is under the proposed regulations. Now, I know they're proposed, but that's the safe harbor that we use. And the proposed regulations do not distinguish. They treat capital interests and profits interests the same. So they do not distinguish. So there's not a distinction. So the reason I brought up the distinction earlier is because, again, the rules used to be you distinguish, now you don't. So proposed regulations would reverse the rule, but allow a safe harbor. So we use these today, even though they're proposed and they're not final regulations, because it's a safe harbor. They came about in the 2000s. So we go ahead and we don't distinguish between capital, profits, interest. We go ahead and we include the value at the time it's received at its liquidation value. All right? So the important part here is that a capital interest, when received, is basically going to be its liquidation value. And there's other ways to look at this, which the regulations specify. But that's generally speaking going to be the hypothetical liquidation, what you would get if the partnership liquidated when you receive the amount. Now, the partnership gets a corresponding deduction with respect to paying for these services. Just so you know. And that's important. Now, that's for capital interest. For a profits interest, as I said, a profits interest under the definition economically, there is no liquidation value. No liquidation value. So when a profits interest is received, the general rule is that you include nothing. But you do include profits, so we include profits as they're received. So basically the profits interest holder would include profits as received, but when the profits interest holder receives the actual partnership interest, they do not have to include that value because the value is going to be zero. So it is a taxable event, but it's going to be zero. Now, there's a few times where the value is actually going to be not zero. So if you go back to the previous slide, we still apply the rules of RevProc 93-27, where these three, a substantial certain income stream, it's sold within 2 years, or a limited partnership interest in a publicly traded partnership, these things actually will have value. A profits interest, so the term for profit in economics is pi. Profits interest does have value. So that would be a value. So where it's not zero. So I'll put does not equal zero. You actually have to value it. So substantially certain income stream is where there's like a partnership that might have like a really long, like a 20-year lease and like real property, and it's had that for a long time. It's very secure. So within 2 years, so you basically have to go back to your year and you have to amend it. And then limited partnership interest, there's a value on that. So that's the key, is that profits interest is hard to value. It's all about valuation is the key. Valuing. Valuation is tough, right? But in certain cases, it can be valued. So I'm going to go ahead and stop there. Again, the Section 83B election portion is something that an advanced topic you might consider, but I'm not going to discuss it here. So that really ends the discussion of contributions to partnerships.